Hello and welcome back to the Geordie Pig Investor channel. Today I'm going to be going through, is VICI Properties stock a buy right now? What is VICI Properties? Well, it is a real estate investment trust. The company is based in New York City and primarily engaged in the business of owning and acquiring gaming, hospitality and entertainment destinations, subject to long-term triple net leases. The firm segments includes real estate businesses and golf course businesses. The real property business segment consists of leased real property and real estate lending activities. The golf course business segment consists of approximately 4 golf courses. Geographically diverse portfolio consists of approximately 28 properties, including Caesars Palace Las Vegas, Harrah's Las Vegas, Venetian Resort. 3 of the entertainment facilities that are on the Las Vegas Strip, some of the biggest known over there. Across 62 million square feet and approximately 25,000 hotel rooms, with approximately 250 restaurants, bars, nightclubs and sports books, the company owns approximately 34 acres of undeveloped or underdeveloped land on and adjacent to the Las Vegas Strip, which is leased to Caesars Palace. So they are a very, very credible business and have built up a lot of real estate. And here are some key stats to do with VICI Properties. So they are an American-based firm. Their market cap is $30.3 billion. They turned into a public company in 2017. They have over 150 employees. Since turning into a public company, they have had a growth streak ever since, so 5 years. They have a 5-year dividend growth rate of 7.25% and a very nice healthy yield at 5.6%. If we have a look at VICI's performance over the last year, you can see it is down nearly 10% over the last 12 months. And we're going to dive into if VICI is a buy, hold or sell right now. Let's have a little look into VICI Properties earnings calls and fundamental analysis. So at the beginning of 2014, the firm boasts a $1.2 billion in cash and forward equity resources. The company had forfeited its financial position by raising over $1.6 billion in forward equity and enjoys high liquidity with approximately $3.5 billion available, including an option to request up to an additional $1 billion on top of this amount. The debt is well managed for a REIT, it being only $17.1 billion, with a net debt to adjusted EBITDA ratio of times 5.5, which I'd like to point out is very, very solid for a REIT. The company's effective growth strategy is reflected in an 8.8% quarterly and 11.8% annual increase in adjusted funds from operations, also known as AFFO. And it's actually looking to increase this further over the next year, specifically translating to an approximate 4% year-over-year increase based on the midpoint of the guidance. So it's looking really good on the recent earnings call that was at the start of the year. And some of their key fundamental analysis points is it has positive free cash flow right now. It has exceptional 3-year average ROI. It has a positive operating income, positive gross profit, solid long-term solvency, very low debt to equity. It does have poor short-term solvency, but that is usually expected with REITs. And it does have a low Altman Z score. Moving on to the cash flow of VICI Properties. Cash flow is the money a company has left over after it's paid for all of its expenses and any investments. Free cash flow has a massive impact on the direction a company may be heading. Now with REITs it is slightly different because they are required to pay out 90% of taxable income every year, hence why they usually pay relatively good and reliable dividends, and REITs do operate in negative cash flow quite frequently, so it's not uncommon to see this. As you can see, back since the firm opened in 2017, it was in a negative free cash flow and continued that trend right the way through to 2021. It then got its head above the waters in 2021, but then dipped back below that in 2022 and has actually recently then now been back up into the green and has actually got over 800 million in free cash flow right now. And they have a really, really good payout ratio of only 72%, which is actually very low for a REIT. So it is very, very good to see and shows that they're actually going to be able to grow their dividend even further, which is one of the main policies of the company and what they aspire to do with their earnings calls. It's what they've talked about multiple times. VICI Properties discounted cash flow valuation. So we're going to have a look into their DCF model alongside the relative valuation as well. And then between the two, we're going to be able to come up with the intrinsic value. The DCF is a method that of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates present value of a company's forecasted cash flow based on a selected operating model. So just to remind you, VICI's current price is around about $29.30, and when plugging in a discounted rate of 8.5% and a terminal growth rate of negative 2.7%, it comes out with VICI being worth around about $18.71, which would be an overvaluation of 36%. When plugging in a discounted rate of 8% and a terminal growth rate of 0%, we're looking at VICI being undervalued by about 6%, being $31.31. And by plugging in a discounted rate of 7.5% with a terminal growth rate of plus 2.7%, you can see that VICI looks at be undervalued at around about 49%, being worth $57.42. So we've got quite the range between the three there, which is why I always find it so important to not just get one valuation, but actually get multiple valuations using different metrics and plugging in different numbers, and then you can decipher what you believe is the best one to go with. So like I said earlier, we're going to then move on to the relative valuation, which is a method used to value a company by comparing it to other competitors based on certain metrics. These metrics usually include EV to revenue, EV to EBITDA, and PE ratios. They're the three that I commonly use, but there is other metrics that you can use on top of this if you wanted to have more metrics involved or you wanted to change the metrics. When plugging in my numbers for the relative valuation, VICI's worst case scenario came out with a massive undervaluation at 37%, being worth $46.78. The base case came out at being undervalued 44% at $52.09. And the best case came out at being undervalued at 48%, being worth $56.11. So now what we can do is find out the intrinsic value, which is going to be adding the two together and dividing by 2. So what this does is gives us a better representation and a more accurate valuation of the company. So like I said earlier, VICI's current price is $29.30. And with the intrinsic value, worst case scenario, we're looking at it being worth $32.75. An average case being worth $41.70. And the best case being worth $56.77. So all three being above that current price. I then like to look into another metric, which is going to be the Wall Street estimates. The Wall Street estimates are an average estimation of a public company's quarterly earnings and revenues that lead to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. There's multiple different analysts for companies as big as VICI Properties that will go through this company on a daily basis and give those accurate accounts for what they believe the price should be for VICI Properties over the next year. The worst case scenario from the price analysts was $31.31. Their average case scenario, they believed it would be worth $36.44. And in a best case scenario, they believe that VICI Properties is worth $45.15. So the overall result that we can gather from this now is I can add the three valuations together and I can get my best, average and worst case scenarios for VICI Properties based on these three different valuations. For me personally, these three valuations have always worked very well, and I believe I'm getting a lot of success using the average case scenario for companies such as VICI Properties. My worst case scenario came out at $32.27. My average case came out at just under $40. And the best case scenario came out at just under $53. So if we're going to put a 10% margin of safety on the worst case price, you'd be looking to buy around about $29.05. With a 20% margin of safety, you'd be looking to buy at $25.82. On the average case, a 10% margin of safety would mean buying at around about $35.96. And with a big 20% margin of safety on the average case price, you'd be looking to buy at around about $31.96. On the best case scenario, if you had a 10% margin of safety, you'd be looking at buying at $47.61. And with a 20% margin of safety, you'd be looking to buy at $42.32. What does this mean about VICI Properties then? Well, is it a buy right now? I think the company is at a really attractive price, and this is mainly due to the high interest rates, as this always puts strain on REITs, leading them being under a lot more pressure and their stock prices plummeting. With interest rates being so high lately, it has driven prices down across the board on REITs. So you can get a lot of opportunities across multiple different REITs. And there's a couple other REITs that I may be looking to dive into myself that are actually UK based, so that I don't have to pay any tax on the dividends I receive. So if you'd like to see those, let me know in the comment section down below. But moving back to VICI Properties, having said that, they only seem to be going from strength to strength. And with the consistent dividend growth coupled with a great dividend yield and growing that dividend at a great rate, I struggle to see many negatives with the company. They've got a really, really solid portfolio, being mainly heavily based in the Las Vegas Strip, but now also branching out elsewhere. So they're really expanding that portfolio, so they're not just heavily reliant on that one area. It's all backed up as well when looking at different valuations of other REITs, that how undervalued VICI Properties is right now. If you look at our overall results as well, to back this up even further, with a massive 20% margin of safety at the average price, it is still comfortably well undervalued. I've personally been adding plenty of VICI Properties into my portfolio at under the $30 mark over the last few months, and I think I will be continuing to do so at these prices. It's definitely one of the best REITs on the market right now. And are you going to be potentially adding a position to your portfolio of this, or do you already own VICI Properties? Let me know in the comment section down below. Please let me know of any other stocks you want to see a full breakdown on. Please like and subscribe if you enjoyed the video. And this is the Geordie Pig Investor, over and out.